Hello everyone, and welcome to the CISI Risk in Financial Services video lectures. My name is Karim Mansour and I am the director at Tadawul Academy, a CISI accredited training partner. Today we shall start with the first chapter, and that is the principles of risk management. There will be 12 questions of it in the exam. CISI has made it clear that this number of questions is just an estimate. You might expect plus or minus 2. So for every chapter, for example, for chapter 1, you'll expect 10 to 14 questions. So there might not be exactly 12 questions in the exam. The CISI Risk in Financial Services qualification is challenging, but like all CISI qualification, it is fair. So if you give it time and you give it effort, you should be able to pass it easily. So let's begin. Let's introduce risk. In every class that I give for the risk in financial services, I always ask the same question. Why do we need brakes in cars? The question is it to slow us down, or is it to help us speed up? Now, of course, most of us, those who drive cars, know that brakes are used to slow us down. But for this question, the answer is wrong. We need brakes to speed up. What does that mean? If you have two cars, one with a brake and one without a brake, in which one would you be comfortable and confident to speed up? I would be more comfortable and confident to speed up in a car with brakes. Cars without brakes, we cannot speed up in them. And that's what risk management is. Brakes are known as a type of controls. Businesses that have proper controls in place, set up by the risk management team and the board of directors, businesses that have proper controls in place are able to function better and make better profits. Businesses that don't have controls in place or have weak risk management will sooner or later fail. So let's start with the first question. It's very likely a guaranteed question in the exam, and that is the difference between risk and uncertainty. Again, in this case, I use another example. I always use the case of fire. If I ask you what are the chances of a fire happening in a building, you might come back to me and say, well, there is a 0.5% chance that a fire might happen in the next 20 years. Of course, how did you obtain those numbers? Historically, through the use of some statistical or mathematical formulas. We will cover these later during the other lectures. But you are able to estimate the chances of a fire happening. And you are able to estimate the losses if a fire happens. So if a fire happens, we might be losing probably $1 million in damages to the property. That is called risk. You are able to quantify it. You are able to quantify it. Now, if I ask you another question and I say, what are the chances of an alien attack from Mars? What are the chances of an alien attacking Earth from Mars and kidnapping you and taking you to Mars? Now, you will take a second, but your mind will go blank. Why? Because you cannot quantify that. You cannot tell me what are the chances of that happening. Probably because it hasn't happened before, and probably because there are no mathematical models that will give you the chances of that happening. And because this event, the event of an alien attack from Mars, kidnapping you and taking you back to Mars, cannot be quantified, cannot be quantified, this is now called uncertainty. It's a very popular question in the exam, and I consider it as a bonus question for the students because it's easy to understand. So just concentrate on the word quantify. Risk can be quantified. Uncertainty cannot be quantified. Now, when you quantify risk, you basically look at two things. One, the chances of that risk happening. Of course, in this exam, the word chance is interchangeable with probability or likelihood. As we are going to see in future chapters, especially in chapter 3, these three words are used interchangeably. Risk that can be quantified, usually the first step of quantifying it is giving it a chance of happening or a probability of happening. And then the second step is, if that risk happens or crystallizes, how much are we going to lose? In this case, we might lose $1 million in damages to property. This is called impact. Impact or losses. Losses is not the right word for it, although majority of type of impacts are losses. But a risk crystallizing can have other impacts on your businesses besides actual losses. So, quantifying risk is looking at the chances and the impact. From this page, you can expect one question in the exam, and that question is most likely going to be the difference between risk and uncertainty. Probability and impact are covered in depth in chapter 3. Now, of course, you have the definition of risk, the chance or possibility of a damage or loss or injury happening. This is the definition, and I don't think, since it's very clear and straightforward, we all know what risk means. Let's continue. The risk framework. This is covered in more details, I think, in chapter 9 under corporate governance. I think corporate governance is chapter 8 or 9, can't remember. But yes, this is covered in more details. But let's go through it quickly now. You've got the board of directors. You've got the risk team, the risk management team. And then you've got the business unit heads, or what we call the front line or the front office, or sometimes called the client facing. Generally speaking, in most companies, this is how the company is structured. So who's responsible for what when it comes to risk? The board of directors are responsible for the risk policies and governance at the board level. They are responsible for things like setting the risk appetite, and they are responsible for setting the risk policy. But there's one critical word that you need to add to that, and that is sponsorship of risk. When you sponsor something, sponsorship of risk management, what this means is that they don't actually manage the risk themselves, but they sponsor the risk culture. Sponsor means support. Employees always look to the board of directors for direction, for leadership. If the board of directors is leading them on the right path, where they encourage a proper risk culture, proper risk management, and proper risk controls, then the employees will follow suit. So what's important here for the board level, that you remember the word sponsorship. It's very important at this stage. Now, the board of directors, they set the strategy, they set the appetite, they set the policy, but they don't run the company on a day-to-day basis. Who does it? Management. You've got the CRO, we call that the Chief Risk Officer, and he runs and manages the risk management team. The risk management team's function are identify risk. For example, we have identified fire as a potential risk in our company. Assess and measure that risk. That means, what are the chances of that risk happening? And if it happens, how much are we going to lose? And whether or not this is acceptable. 3, controls. Put controls in place. We'll study types of controls later, but for example, controls for fire are fire alarms, extinguishers. Monitor the effectiveness of these controls. And of course, you have to report it to the board, but it's not part of this chart right now. Well, this chart is covered in more depth in chapter 3. So right now in chapter 1, all we're doing is introducing the principles or the fundamentals of risk management. But this chart right here is covered in depth in chapter 3. What we're trying to do here is just introduce to you the basic ideas of risk. And now we've got the third department, and that is the business unit, or the business, or the front office. They are responsible for day-to-day risk management. Look at this word, risk management. They are responsible for basically fighting risk, since they are the ones who are facing the clients, and they are the ones who are on the operational level. The business unit is what we call the first line of defense. The critical word for you to know here is that they are the business ownership. They are the risk owners, sorry. Risk ownership means the responsibility, the first and main responsibility of reducing risk or reducing the chances of risk happening falls on the employees, the business units, the day-to-day operational part of the company. So from this page, we have looked at 2 very important words, and that is sponsorship, that's the responsibility of the board of directors, and ownership of risks falls on the business unit. Now let's look at the external and internal sources of risk. What risks do companies face, both externally and internally? Now, if you have taken any management course in college, you would have covered PESTEL. Sometimes people write it like this, or sometimes people write it like this. It's the same thing, just that the L and the E are switched. This L and this E is the same thing. So external means outside the company. What sorts of risks the company is facing outside. Now, of course, since this is the risk in financial services qualifications, we are mostly going to be looking at banks, the risks that banks face. So let's start with letter P, and that is the political risk. Politics has a big effect on businesses, mainly when it comes to changing government and tax. A new government might come in and they might increase the tax on companies. That means you will be losing more money. That's a financial risk. A change in government might come in and change some policies, for example, reducing the potential for your export, limiting how much you can mine or dig in earth. These are all chances of you losing money. 2, economic risk. How do you define economics? Some people say it's demand and supply. There's a better definition, and that is understanding human behavior. The way humans behave, their appetites for certain products will affect you. So if people suddenly stop liking coffee and they have started liking, let's say, tea or soft drinks more, there is a big effect on Starbucks profitability. So understanding how humans behave and the effect of that behavior on the company's financials is very important. S stands for social. Social means the market, competition. Competitors gaining market share, this is a massive risk. Attitudes to saving and credit. I remember a few years ago there was a video on TED Talks, if any of you watch TED Talks. I can't forget the name of the person or the video, but I do remember vaguely they were talking about an Asian country, an Asian culture. I forgot which country exactly. They have a high attitude to saving. They save more than they spend, which is of course contrary to most current cultures where people spend more than they save. They looked at this culture, this Asian country, why are they saving more than most cultures around the world? And they discovered that their language, the language that they speak, if I remember correctly, does not have the word will. For example, I will start tomorrow. I will start saving tomorrow. I will start planning next month. Or I will buy a house in 10 years. They don't have this word will. And because they don't have the word will in their language, they are more likely to make decisions quicker without postponing. They don't postpone today's work because of the language that they speak. And because of that, they have a high attitude to saving. And you have countries like the US, for example, they have high attitudes to credit. The government and the financial sector makes it very easy for them to borrow. The fourth type of risk is technology or cyber risk, which is the risk that you will be hacked and sensitive information about your company and your clients might be stolen. Legal risk, a risk from your clients suing you for bad treatment or faulty products or bad quality. You might be sued by your investors. I think Elon Musk of Tesla a few years ago was sued by the investors. Investors pose a big legal risk on the company. Major investors, those who hold the majority of the stocks. And finally, environmental risks. These are natural disasters, things that are basically related to either the environment or to the natural environment or to the business environment where the company is working. So these are pastel. When studying for the exam, you need to study this external sources and the internal sources, which are on the next page, together. You need to separate between them. So for example, you can draw a table that says the sources of risk. The sources of risk, can be split into two. You've got the external sources and you've got the internal sources. So under the external sources, we've got pastel, and then under the internal, which on the next page, you've got the strategic, and you've got the operational, and you've got the financial, and so forth. So know how they are differentiated. You will be questioned on this in the exam. So let's look at the internal drivers of risk. How risk can happen internally inside the company. We start with the first and obvious one, and that is strategic risk. So, is the strategy right? This is basically linked to the board of directors because they set the strategy of the company. So how do you define strategic risk? So this is basically linked here. This is basically defined here. Adverse business decision, that means bad business decisions. Let me give you an example. Let's say a bank in the UAE decides to open an office in Kenya, a branch in Kenya. That is a strategic move, most likely decided by the board of directors. Now, the risk here is the strategy right, or is it being implemented properly? By moving into Kenya, let's say the UAE bank, the move failed. Moving into Kenya and establishing a branch failed, and the company suffered losses. Why did the strategy fail? There are two reasons. Either the strategy was not right. Was the strategy right? Nope. Kenya market was not ready, or the products and the services that this bank is offering do not suit the Kenyan market, or for other reasons, for example, they did not meet the regulators' requirements. The strategy was just not right. But there's also another chance. Some people will say the strategy was actually right. Moving into Kenya was the proper decision to make. However, we did not implement that strategy right. The Kenyan market needed our products. They were very suitable for the Kenyan market. We met all of the requirements. And if we had implemented that strategy right, we would have made money. But we did not implement it properly. For example, we did not recruit the right employees to run the branch. That's one of the ways that the strategy is not implemented properly. So strategy risk can be divided into two. Was the strategy right? If it wasn't, it's not going to work. And even if the strategy was right, did you implement it correctly? If you don't implement it correctly, you will still lose money. The second type of risk, internal drivers of risk, is operational risk. This is the risk resulting in failed internal processes, but that's not the complete definition. The whole of chapter 3 is on this. Operational risk is the risk from people, that means your employees making mistakes or defrauding the company. Processes, which are procedures. Systems, mostly your IT. And external events. Now this gets a bit confusing because people remember that we are talking about the internal drivers of risk. Then why are we talking about external? Now operational risk is the complete definition of our operational risk. People internally inside the company, processes inside the company, systems inside the company, and external events. It shows you that internal and external drivers of risk influence each other. And this is a question that comes in the exam. Why is it important for us to study internal and external risk together? Why should you look at or study external and internal risk together? And the right answer is because they overlap. And this is the word that you need to use in the exam. That means they are connected. They influence each other. So the second type of internal drivers of risk is operational risk. Why is it internal? Because it's mainly caused by your employees, your procedures, and your IT. Third one is compliance risk. Even though compliance risk means complying with the regulators, and the regulators are external, compliance risk is an internal risk. Why? Because failing to comply is most likely caused by the company internally. You did not implement the proper procedures to comply with the regulators' requirements. So compliance risk is an internal driver. And then finally, financial risk, which is the risk of you losing money. Revenues versus cost. For example, higher costs and lower revenues is going to cause you to lose money. You are very much leveraged. Leverage is most likely the American word. Gearing is the British word. You go massively in debt. You do not manage your debt properly, and this puts a lot of pressure on your balance sheet. The BIS No need to worry about the BIS now. We studied it in chapter 2 completely. This is the Bank for International Settlements. But they are considered to be the central bank for central banks, the regulator for regulators. And they issue international standards for banking. We will cover BIS in detail in chapter 2. A BIS says there are 3 types of financial risk, and these are financial risk means risk that influence your profitability. So you've got credit risk, and I believe this is chapter 4. And you've got market risk, and I believe this is chapter 5. And you've got operational risk, and I believe this is chapter 3. We'll study these in more detail later.